Yeah, it's that wonderful time of year again. What I did, the tax laws change all the time. I mean, I get a daily email showing everything that happened yesterday. And so I just tried to hit some of the highlights, some of the main things. The first one on my handout, for those of you that don't know, when you buy a piece of equipment, a computer, furniture, a vehicle, you're allowed to make an election under Code Section 179 to go ahead and expense the entire purchase price in the year that you buy it. Otherwise, you have to capitalize it, and it gets written off over normally a 5 or a 7 year life. Back when W was president, to stimulate the economy in 2001, we used to have a $25,000 deduction. He increased it. I think he went all the way to 500. He may have started out smaller back then. Slept a few days since then. But it was originally meant to stimulate the economy. And since then, Congress has dilly-dallied around and waited until usually February or March of the following year, and then made a retroactive law to reinstate the Section 179 expense, which doesn't really stimulate the economy. Helps us because, as you know, the accountant, we're like, yes, we got our deduction back. But to actually stimulate the economy, it doesn't do any good when you find out in February of 2016 that you could have taken this deduction back in 2015. So the good news is in December of 15, they finally made this permanent and they indexed it for inflation. So we can actually plan on having a good write-off for buying equipment. Along the lines there, in addition to stimulating the economy, they decided that for restaurants and retail, normally you have to, if you build out your space that you're leasing, you have to write it off over 39 years. They cut that back to 15 years, and then they also have allowed us to expense up to $250,000 of that. So that can be a big help, especially if you're starting up a new storefront. Past few years, we've had this bonus depreciation where you're allowed, it's actually mandatory that you write off 50% of any new assets that you buy. In the year that you buy them, you have to elect out of it. That expired at the end of 2014, but they did make that, they reinstated that, and it phases out, I think, up through 2019, and then we'll see what they do after that. One of the big things that has really caused a lot of consternation in our profession, little history, the IRS lost a case against FedEx. I can't remember, probably 10 years ago. What FedEx was doing was, because your airplane engines, the FAA requires them to be completely overhauled every so many thousand miles or so many hours of flight time. And, to overhaul one of those engines is, thousands and thousands of dollars. Well, FedEx had decided that they could expense that because that was a necessary repair, and the IRS fought them, went all the way to the Supreme Court, and they lost. So FedEx was able to continue to expense that as a repair. Our profession jumped on that immediately, and we started, okay, if you've got a rental property, you got to put a new roof on there. Well, you originally had a roof. It has a hole in it. You put a new roof on it. That's a repair. IRS thought that should have been a new asset that you write off over 27 or 39 years. But so it's just been, things like that have been a constant battle back and forth. Well, the IRS, the week between Christmas and New Year's back in 2013, passed a rule that said originally was anything over $250 you had to capitalize and write off over 5 or 7 years. And, of course, everybody that could fight against that was on vacation that week, and they made it effective January 1st of 14. And so it kind of snuck in on us. Our profession fought them. It's gone back and forth. They finally settled on a $500 limit that anything over that you had to capitalize. But then they allowed you to expense anything under the $500. And we've since been arguing back and forth with them. Starting in 2016, they raised that threshold to $2,500. And actually analyzing the law, it's kind of a pointless law. It's basically the IRS throwing a temper tantrum because they lost FedEx and they're trying to get even with us, all of us taxpayers. But effectively, if the way the law was originally written, if you put new tires on your vehicle, you have to capitalize them and write them off over 5 years instead of getting to expense that as a repair. The way the law has been tweaked, the IRS looks at it that if you plan on replacing something more than once during the lifetime of that asset, so it could be, like if you plan on, you're going to drive your company vehicle enough that you're going to put a new set of tires on it before you trade it in, then you can expense it. So, I mean, in retrospect, it's really just more paperwork that we have to file. There's an election that you have to attach to your tax return saying that you agree to follow those rules, but then the bottom line is most people aren't. I mean, they're still doing what they were always doing, and there's really nothing they can do about it. Part of what they changed at the end of 15 were some filing dates. The big one that kind of caught us, what they're trying to do is they're trying to stop all these fraudulent tax returns. The problem is right now, they allow you to start electronically filing January 18th, but W-2s and 1099s are not required to be sent out to all your employees and your vendors until January 31st. If you paper file, you don't have to send the employer's copy to the IRS to let them know what all you paid until February 28th. But if you electronically file, you have till March 31st. And so that coupled with pass-through entities like subchapter S corporations and partnerships, the corporations don't have to file their tax returns till March 15th. Partnerships, trusts, and estates don't have to file till April 15th. And so all this information that is supposed to be on your tax return is getting filed way after you're allowed to actually file your return. So there's no way for the IRS to be able to know what should be on your tax return until well after you've filed. To combat all these fraudulent tax returns and identity thefts that are going on, they're trying to push it to where things are filed before you actually start filing your income tax returns. Their ultimate goal is that by the time you send in your individual return, everything's been filed, and their computer can just check, yeah, you've got everything, you are who you say you are, the return's filed. Because of the way our system has been working for the last 80 years, it's going to take them a while before they get there. But they're starting to change. So one of the things that they did was starting next year in 2017, when you send out W-2s and 1099s, not only do you have to send them out to your employees and the vendors by January 31st, but you also have to file them with the IRS and Social Security Administration by January 31st. Then they flip-flopped. Regular corporations used to be due March 15th. Now they've been pushed back to April 15th, where partnerships have been moved from April 15th back to March. So they're trying to gradually move to where they're going to have all the information in a timely manner. The one thing that we thought was funny with that was if you have a fiscal year-end corporation that ends their year on June 30th, they don't have to make the filing change until 2026, which nobody knows why. That was just, so we figured somebody's relative or something must have had a June year-end corporation and they didn't want to make the change, so they made it law. But on the second page, I just basically, the mileage rate for 2015 for business use of your vehicle is 57.5 cents a mile. In 2016, that drops to 54 cents a mile because the gas prices are dropping, so they figured it costs less to operate your vehicle. I kind of just hit a little bit on the Affordable Care Act. I know that's a huge topic. I could probably spend days talking about all the things that we're supposed to do and all the things that are wrong. with the way they administer it right now. But basically, if most of my clients, and probably most of us in here, if you have fewer than 50 employees, there's really no problems. You're not required currently, nor in the future are you required to provide health insurance for your employees. If you do, you just can't discriminate, and have one, Cadillac policy for the owner and, have a really bad policy for your employees or something. You have to offer the same thing to everybody. The big thing that came about when all this started coming into play in 2014 was, if how expensive it is to offer a group health insurance policy if you've got a small group. The original intent of the Affordable Care Act was that if I'm, 45-year-old, male, it shouldn't matter whether I work for Devon or I own my own business. My insurance should cost the same. That was the original intent. It's gotten twisted, and but basically, one of the things that employers were doing was, if you could get a better, say, covered on your spouse's policy, you could get a better rate than what your employer could offer if you got on their group. Then the employer would turn around and say, like, I'm currently on my wife's health insurance, so if my employer wanted to pay for my health insurance, they could reimburse me what is being taken out of my wife's paycheck. With the Affordable Care Act, that is illegal. You cannot do that anymore. If you do, it is a $100 per day per employee fine. And when they first passed that law in 2014, basically it's a $36,500 fine per employee that you do that on. And there was a big uproar. The IRS said, okay, we didn't realize it was going to be that big of a deal, so we'll back off for a year. The Department of Labor, however, came out and said, IRS may not be enforcing this law, but we will, because they would love to get their hands on that $36,500. So basically, the takeaway on that is stop doing that. Stop reimbursing your employees' health insurance. If you're going to continue to do that, then you should do it as W-2 wages. You should just increase their salary. You cannot earmark the salary as a reimbursement for health insurance. You just have to give them, if their health insurance is $250 a month, you just have to give them $250. And they can, theoretically use it for whatever they want. You and they both know that it's for the insurance. You just can't say that it's for the insurance, or you subject yourself to that fine. Employers with 50 to 99 employees have to provide their health insurance starting in 2016. The large employers, 100 or more employees, had to start providing health insurance for their employees January 1st of 15. The penalties that you hear about for not providing health insurance are very cumbersome and hard to calculate, but the basic gist of it is anyone that's worked more than 30 hours a week is considered full-time. If you're required to provide health insurance, you only have to provide health insurance for the people that are considered full-time. So they have to work more than 30 hours a week. And then the only time you actually owe the penalty is if one of those people that you should have paid health insurance for and you didn't ends up going onto the marketplace and qualifying for a subsidy, the premium tax credit to make their health insurance more affordable. So it ends up it's not as bad as they try to make you think it is, but it still is kind of a pain to keep up with. A couple other things: your health savings accounts, flexible spending accounts through work are still allowed. The health reimbursement arrangements are not. They fall under that, providing health insurance for your employees. You could still do small things like dental, vision, cancer policies, things like that, but you can't, run an employee's health medical expenses through a health reimbursement arrangement anymore, like we used to be able to. And then the last kind of thing that I threw on there was the small employer health insurance credit that we used to all have. Expired 12/31/15. It's basically been useless since 12/31/13 because starting in 14 you had to buy your health insurance through the business marketplace called the shop, and then they turned around and and they turned around and then decided that nobody had to have the shop, that they didn't have to get them set up in 14. So anyway, a lot of information. Sorry, I was kind of going fast. If you have any questions, please feel free to call me. My information is on the bottom of these pages. So.